Greetings from 3Edge Asset Management. My name is Fritz Folts, and I'm the Chief Investment Strategist here at 3Edge. And I'm pleased to be joined here today, once again, by Steve Cucchiaro, President and Chief Investment Officer at 3Edge Asset Management. Today is Saturday, May 2nd, and as Steve and I have done each week during the COVID-19 crisis, we'll be providing a brief recap of the past week in the global capital markets, and we'll also look at some topics that we're paying close attention to here at 3Edge. As a reminder, all of our videos are available on our YouTube channel, and you can simply go to YouTube and search for 3Edge Asset Management. Don't forget to subscribe and select the bell icon so you'll receive notification as our new videos are released. Meanwhile, in economic news, millions more Americans filed jobless claims last week, sending the 6-week total above 30 million since the coronavirus pandemic began to force businesses across the country to close their doors. The number of claims implies that we're headed towards a jobless rate close to 20%, which would be the highest since the Great Depression in the 1930s. Now, comparing what transpired in April between the stock market gains and the job market losses gives new meaning to the topic which Steve and I discussed last week of not confusing the market with the economy. So now as we head into the month of May, and as the world and the US begin to reopen their economies, investors are faced with having to decide whether the stock market may need to head back down again based upon the dire economic realities of the COVID-19 crisis, or as the US begins to reopen for business, will the economy hit bottom quickly and begin a V-shaped recovery, thereby validating the stock market run-up in April. So now I want to bring Steve in, because I think that I have a chart that could at least provide a partial answer as to why the stock market enjoyed such a strong month in April, even in the face of mounting job losses. So Steve, let's take a look at this chart, which shows the recent growth of the Fed's balance sheet, which we could certainly describe as being exponential, since that's how we describe something that's growing by large amounts and very quickly. Could you explain why the Fed has stepped in and increased the size of the balance sheet so dramatically in response to the COVID-19 crisis, and what it could mean for the capital markets in the future?
Well, Fritz, you're absolutely right. And this chart highlights why the stock market behaved so differently than what we've seen in the economy. And while some of the gains in the stock market since the bottom on March 23rd were due to optimism about possibly a quick recovery with many states in the country opening up, a lot of it has to do with what the Federal Reserve Board has recently done that is completely unprecedented, and this chart will show it. This chart, the horizontal axis, shows from left to right 1994 through the present. And the blue line shows how big the Fed balance sheet is. And why that's important is it shows to what extent is the Federal Reserve Board maintaining normal practice, or to what extent are they introducing emergency measures to actually create money out of thin air to support spending and trying to rescue the economy. So we see that historically the Fed has had a very, very smooth gradual rise supporting normal economic growth. And then the first spike up shows what happened in 2008, 2009 financial crisis, trying to get the economy out of that severe recession, the worst recession we had since the Great Depression. And that was considered totally unprecedented, totally extraordinary. And now you go all the way to the right and you see how incredible the expansion of the balance sheet is. And what this represents is a situation where the Treasury, representing the government, the Federal Reserve Board, are now hand in hand, where the Treasury, that already has $21 trillion worth of debt, wants to spend several more $1 trillion for bailout packages to try to help the economy. And instead of going to the market and trying to raise that all at once, which could make interest rates go very high, they're going straight to the Federal Reserve Board where they are printing money. And that's why the balance sheet is going up, because they're adding to the balance sheet. They're taking that printed money, buying the debt from the Treasury, putting it on the balance sheet, trying to relieve the pain of businesses and consumers. And the degree to which they've done that is shocking. And so when we talk about that tug of war between the economy going down and the massive intervention from the Fed pulling it back up, we saw how in the last month and a half, the Fed has really ruled. And what that's done is, as the stock market bubble and the corporate bond market bubble get pricked, and the market fell sharply from February into March 23rd, their intervention artificially lowered interest rates below what they normally would have been and helped companies take on more debt to try to remain viable, hoping that this only needs to happen for a short period of time.
This brings me to my next question, actually, because one thing that's indisputable is the takeaway from the reaction to the global pandemic is an explosion in the increase in global debt worldwide. And so my question is, what will the consequences down the road be of these now extraordinarily high debt levels? And could this ultimately lead to economic stagnation or even stagflation or some environment that's very negative?
So we should all be concerned about that. Now, we've been saying since even before the coronavirus hit that the stock market was being fueled by bubbles, by extraordinary Fed stimulus. And that during that period, we ended up with excessive record level corporate debt on top of excessive near record level government debt. So we already had an economy and a set of companies that had too much debt. And as long as there would never be another recession, there was a chance that they could grow their way out of it. Well, then the coronavirus hit. And what's the answer to that problem of excessive debt? Well, our answer is just pile on even more debt.
Right.
And when debt gets this high, and there have been a lot of historical studies that have been done, it becomes more and more difficult to grow your way out of the debt, because what debt is it's borrowing from the future, trying to help the present, but then taking away from the future growth opportunities. And when debt gets more and more excessive, it's been shown that the productivity of that debt, or the ability of that debt to grow the economy, becomes less and less. So when you have too much debt, the best case scenario is you grow your way out of it. And it doesn't seem like that's going to happen anytime soon. And even the most optimistic scenarios are that we try to get growth somewhere near where they were before, but not too many people are counting on that. Next, you can tax your way out of the debt, because after all, who owns all this debt? It really falls on our taxpayers. But if you're in a recession like we are now, and you greatly increase tax rates, then you just further stall the economy and economic growth. And while the tax rates might go up, the tax revenue might keep going down, and that doesn't really help. And so then the third way is you try to inflate your way out of the debt. And one way that many countries have done in the past is they try to weaken their currency, so they effectively get people who lend them money, or the bondholders, to subsidize at unfair low rates the companies or the governments that are borrowing. And we think that might be the most likely case. So we think that one should be very careful putting too much money into the corporate bond market. Right now, prices are artificially saved because of all this market intervention, this artificial intervention that the Fed did to lower rates. But what that means is that if you invest in the corporate bond market now, you're getting an unfair lower rate, and you're not getting compensated for the extra risk you take. And of course, if we have a V-shaped recovery and everything's back to normal by July, then everyone will say this was the effective bridge that got us to where we needed to get to, and all is well. But if the economy stagnates beyond that, I think this debt is going to loom as a bigger and bigger problem.
Yeah, very good, very good. So one quick thing before we go, and April was obviously a very strong month, but April was then and May is now. And on Friday, it looked like markets got nervous once again when two tech bellwether companies, Amazon and Apple, both reported somewhat disappointing earnings. But I thought what was even more telling was this idea. They talked about how it was really impossible to provide guidance into the future based on just the unprecedented amount of uncertainty because of COVID-19. And also we had President Trump rattling markets as well, ramping up tensions with China again, sort of blaming the Chinese for the spread of the coronavirus. So I guess we'll have to stay tuned and see if May will be the opposite of April or similar or hard to
Well,
tell. What are your thoughts on that, though?
what I think is that there's never been a wider disparity between the optimistic scenario and the pessimistic scenario. In the optimistic scenario, we're going back in the stock market to make new highs. In the pessimistic scenario, it's going to look more like the Great Depression, where you have that initial down, you have a relief rally that doesn't last, and then you have a more gradual but extended down market. And so this has not been a year for a traditional buy and hold strategy.
Right.
There's a lot of people get whipsawed now because we believe that the stock market was overvalued and the corporate bond market was overvalued back in late January. We entered that downturn very conservatively, and that certainly served our clients well. And then on April 2nd, we had signals from our model that it had fallen so far so fast that there are certain pockets of the equity market that were subject to a rebound. And that happened to a great degree in late March and then into April. And then on Thursday, our model indicated that that rebound had very limited upside with the potential for more downside. So we got very conservative with equities again. And based on what we just previously discussed about the massive Fed intervention, we added even more to our gold holdings. So we think that we will be positioned in the event that things don't go as well as the optimists hope.
Right. So need to be a wee bit nimble in this environment.
We think so.
So that'll do it for us. Steve and I will be back next weekend with another edition of the 3 Edge Weekend Update. And remember, all of our videos are available on our YouTube channel. So on behalf of Steve and everyone at 3 Edge Asset Management, we urge everyone to do everything possible to remain safe and to stay strong and to keep the faith. So thanks for listening.